There are currently more than 8,000 exchange trade products globally. Their aim is to simplify investing, but it's easy to get lost with so many options. Ultimately, when choosing an ETF, ask yourself three questions. What exposure does this ETF have? How well does this ETF deliver exposure? And how effectively can I access this ETF? I will explore each topic further and help you understand how to choose the best dividend ETF. If you want to invest in ETFs, you'll first need to know how to evaluate ETF performance. Performance doesn't just mean how much money you make or lose as an ETF's underlying index rises and falls. It's also about how closely the ETF matches the index performance. The two ways to see how closely an ETF matches the index performance are tracking error and tracking difference. Tracking difference addresses how closely the ETF tracks index returns, while tracking error reflects how consistent over time the tracking quality is. Another important factor to consider when looking at performance is the ETF provider. In a fast-growing sector such as ETFs, these products come in many flavors such as size, scale, expertise, and commitment of the provider, and can vary across the market, but are all important factors to consider as they can impact performance. Furthermore, different indices select their holdings using different rules. Therefore, choosing which index to be the underlying base for your ETF is very important. For example, there are a few indices that cover dividend entities such as stocks and bonds, and use different strategies such as dividend growth and high-yield dividends. In fact, you can find country-specific, regional, and global assets, and get access to entities, fixed income, or maybe even property and commodities. However, when selecting dividend ETFs, pay attention to key factors such as dividend history, dividend yield, the fund's performance, expense ratios, the fund's top holdings, and assets under management. And all this information can be found in the fund's prospectus. Consider the ETF structure next. In general, there are two types of ETF structures that you come across. A physical ETF holds the underlying assets or securities of the index in the same or similar portion of the index. The synthetic ETF seeks to replicate the index performance using derivatives. Why should you care about this ETF structure? Both types of ETFs, physical and synthetic, have advantages and disadvantages and can affect the level of risk and the cost of the managing of an ETF. So it's best to know what you're buying. Typically, though, physical ETFs are the most common. If this topic interests you, leave a comment below. I can certainly make a video about this next. So what does this ETF cost you? The great thing with ETFs is they generally cost less to invest when compared to managed funds. There are two costs that will incur when buying ETFs, the transaction cost and the annual management fee. Transaction costs are those fees that when you pay when you buy or sell your ETF through your broker. The annual management fee combines the asset management costs, bank charges, audit fees, and the tax that the ETF may be liable for and to pay on its investments. Adding these will help you give a complete total cost of ownership of the ETF to compare with other investment tools. However, it's important to look beyond the management costs, such as the total expense ratio, ongoing charge figures, and other relevant fees related to the management to determine the true and total cost of your ETF. Dividend ETFs offer appealing features, but also come with risks that investors should be aware of. There are two main types, dividend-weighted and yield-weighted ETFs. Dividend-weighted ETFs focus on large-cap companies with a consistent track record of distributions, offering defensive income-generated equity exposure. However, they may have lackluster yields and a significant overlap with traditional index funds. On the other hand, yield-weighted ETFs prioritize companies based on yield, providing a juicy dividend payment. However, they can be heavily concentrated in speculative securities or heavily concentrated in single sector or an industry. An example of risk associated with dividend ETFs is seen in the oil and gas industry. During the oil price collapse of 2014-2016, dividend-focused ETFs faced challenges. Even seemingly safe large-cap companies had to cut dividends due to the industry struggles. Energy giants like Exxon and Chevron faced financial hardships but continued to pay dividends, while smaller, riskier energy companies faced higher risk of failure and eventually cut their dividends. The suppressed energy sector and energy prices posed selling pressures on yield-weighted ETFs as the companies within the ETF had unstable payout ratios. Therefore, investors should be aware of the potential risk associated with dividend ETFs, particularly in volatile sectors. Overall, when choosing the right ETF, consider three factors: performance, total cost, and the credentials of the ETF provider. By evaluating these elements, you can make informed decisions and align with your investment goals and increase your chances of success. Thorough research and careful evaluation are critical in selecting an ETF that suits your needs. Thank you so much for watching. I know you hear this all the time, but please hit that like and subscribe button. It really helps my channel. And if you like these videos, please tell me in the comment sections and anything else you'd like me to cover.